Thank you very much. And good afternoon, everyone, and welcome to Wellington's first quarter 2014 results conference call. I will be discussing our key financials for the first quarter, and then Greg will comment on the outlook for 2014 and beyond. We'll take questions. Greg and I can be reached after the call for any additional questions you might have. I must start with the usual warning. We'll be making forward-looking statements on the call today, as these are predictive in nature. They're subject to a number of risks and uncertainties relating to Wellington, its operations, the markets in which it competes, and other factors, some of which are beyond the control of Wellington. Actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. The quarter one result was largely consistent with our expectations, albeit that revenue was a bit softer. The key features of the result are we sold 295,000 motors in quarter one, which is the same volume as in 2013. US dollar revenue was $5.1 million, down from $5.5 million in the same quarter last year, reflecting pricing decisions to both retain volume and win with existing customers and to win new business from our competitors' customers. Some customers went into 2014 overstocked, and that also had an impact. On a regional basis, Europe revenue for the quarter was up 104% to $1.8 million US, but we were down 33% in Latin America to $2.6 million USD. Gross margin was 16.6%, a slight improvement on what we expected and consistent with the same quarter last year. So the price reductions we offered have been offset by lower motor costs from the Chinese supplier. We negotiated a 5% reduction in quarter one from our Chinese supplier, although the margin improvement from that reduction does not flow into our results until Q2. We also moved PCB production in the quarter to a new supplier located in the Philippines. This will give us additional margin improvement from Q2. East West, our strategic partner and second motor supplier, is supplying motors to Wellington now and will be fully ramped in Q3. This will give further margin improvement from the fourth quarter. Operating costs in quarter one were consistent with last year, despite a 10% headcount increase to accelerate product development and in-market capability. In the quarter, we incurred non-recurring costs to move to new premises in Auckland and to implement the closure of our Singapore office. EBITDA was a $1.1 million loss, a slight improvement on our 2014 plan and consistent with the same quarter last year. The average USD NZD exchange rate in the quarter was 0.8221, largely unchanged from the 0.8278 for the comparable period last year. Working capital was $3.9 million, consistent with last year. Cash at 31 March, the end of the quarter, was $1.5 million, but has obviously been boosted by the recent $5 million share issue. At this point, I'll hand over to Greg to talk about the progress towards the 2014 priorities.
Thanks, Howard, and good afternoon, everyone. Before I start, just a small correction on one of Howard's talking points. The new supplier was in Indonesia, not in the Philippines.
Got my geography wrong.
So you got your Southeast Asia country wrong, Howard, sorry. So that's Indonesia, not the Philippines. So anyway, thanks everyone. And before I start, and we'll go to questions and answers after this, let me just touch on what happened over the last several days that led us to our trading update yesterday beyond the Q1 results in terms of the revenue downgrade. We basically had two major Latin American customers warn us of demand decreases starting for the balance of this quarter, and with a month to go in the quarter, this was concerning, and also indicating that their needs in third and fourth quarter could be reduced. All in all, these customer updates convinced us that we should continue to meet our commitment of letting shareholders know what is happening in the business, be it good or bad, and we should update you all on what's happening. What has driven these demand changes is both reduced demand from major brands in that region, as we've talked about previously, and due to that weak market demand situation, more competitive pressure on the volumes that remain. So how are we responding? The way we're thinking about the Latin America situation is it's a fairly normal market cycle issue. As Howard already mentioned, there was some overstocking generally in the market coming out of 2013, which customers are dealing with now. And we think perhaps we're seeing some slowness around World Cup time. In addition, the competitive environment is getting a bit tougher. but our supply chain changes and new products will help with that over time. I would also say that we're being very measured around where we give price to save demand. It's obviously a consideration when our competition is getting tougher, but we're considering what volume we price into and what volume we let go if we can't make the pricing work. But overall, our volumes are consistent with 2013. Our Latin American customer relationships are all intact, so we feel like when the demand comes back, we will see improvements. In addition, we are staying the course on the strategic growth actions we started at the beginning of the year, because we think those actions will ultimately improve the business and solve for areas such as Latin America market concentration, the supply chain cost point, and a broader product range. So just quickly, how are we doing against those priorities year to date? Firstly, we said we would establish sales partnerships to access growth opportunities in new markets. In first quarter, we did 2 deals, one in South China with Ting International and one in the US with our supply chain partners East West, who are now a growth partner as well in the US. Both are creating a funnel of new opportunities that we hope will flow into 2015. We are currently also working on additional sales agreements with partners in Asia and Europe. Secondly, we said we would focus on revenue diversification through increased business with our supermarket display case manufacturers. Admittedly, this priority is going a bit slower than we would like, mainly due to some large supermarket brands pushing spend decisions out until Q4 this year. That said, we are adding customers in this space. We added 1 new customer in first quarter in Canada, and we continue to work with our supermarket customers to develop new solutions for their brands. Thirdly, and a new priority that we've added since the beginning of the year, is the completion and launch of our next generation EC motor. As I said, this is a new priority and we've just added this. This is our new high efficiency, super quiet motor. It's also a single voltage motor that can be used anywhere in the world, and we expect to complete it by the end of the year. Just as an aside, hopefully some of you can join us at our annual general meeting on Monday, because we will be doing a show and tell of all our new products at that annual general meeting. So you would be able to see them working then. The fourth priority is around our smart controller. And we've tuned this priority a bit to now be achieving a field trial with a customer by the end of 2014. Our smart controller is almost completed. We are now moving to the tooling phase and field validation phase. We are hopeful of starting a customer trial in Q4 this year, and discussions are underway to confirm this. And then lastly, our East-West transition, and this was the supply chain transition to enable a lower manufacturing cost point. I'm pleased to say that East-West are now a qualified supplier on a number of our part numbers and are currently ramping their production on those part numbers. We are working over the next 2 to 4 months to complete the qualification of motors that we would need for Q4 this year, and this transition is well on track to expectations. We are comfortable with the way the supply chain transfer has happened, and beyond that, see plenty of opportunity to expand the relationship. For example, the sales partnership we recently signed in the US. Just a couple of quick points before I finish. One other update, which some of you have asked me about before. We are now seeing returns from our fuel pump controller licensing agreement, which you might recall we did early in 2012. Yes, it's taken a long time to come through the marketing and sales of that product, but we now have 2 quarters of financial recovery so far, and it seems to be running at about $20,000 a quarter. And we will see where this goes, but it is very encouraging after a long wait to get this moving. Finally, I wanted to thank those of you on the phone who did participate in our current capital raising, as this investment will really help support us on the new products we are bringing to market and the new markets we are developing. You're all welcome, of course, to our annual general meeting, which is next week on June the 16th. And just another point, on that annual general meeting, we will have the East-West, one of the East-West founders, their president, will be at that AGM saying a few words, and will also be available to our shareholders for questions after the AGM. So thank you, team, and we'll now move to questions and answers.
Thank you, Mr. Allen. The question and answer session will be conducted electronically. If you would like to ask a question, please do so by pressing the star key, followed by the digit 1 on your touch-tone telephone. We will proceed in the order which you signal us, and we'll take as many questions as time permits. If you are using a speakerphone, please be sure your mute function is turned off to allow your signal to reach our equipment. Once again, please press star 1 on your touch-tone telephone to ask a question. We will pause a moment to assemble a queue. Once again, if you would like to ask a question, please press star 1 on your telephone at this time. We will now move to our first question from the line of Roger Armstrong from Spring Asset Management. Please go ahead.
Hi, Greg. Can you tell me what you're doing in terms of taking costs out with obviously this deterioration in your trading outlook? I mean, your financial resources are obviously reasonably limited, and I suspect the runway for getting further resources has just been cut off. So what are you doing about this?
Yeah, thanks for the question, Roger. So there's a couple of ways we're looking at this and some specific things we're doing. Firstly, we had in our plan for this year the addition of a number of new resources that would be supporting new product development, supporting supplier management, and also new sales headcount in the regions. What we've done over the last couple of days as we've looked at our forecast is we've decided to either not add some of those resources or defer some of that investment. I'd have to say I haven't taken it to zero. We think, as an example, having additional sales horsepower in Europe right now could be quite important. So some of those pure marketing, moving the top line dial investments we'll probably still make. But some of the engineering and administrative changes that we've made to kind of increase the company's operational capacity, I think we'll defer or maybe not do it all. I haven't really confronted yet reductions in the current structure. That might come, Roger, but I think it's all about making sure we're investing or not investing, as the case may be, according to what our bottom line says. The other side of it as well is we're going to our supply base. When demand goes down or we're under pricing pressure from competitors, we go into our supply chain and look for more price reduction out of those suppliers. So we're doing just that with both East West and our Chinese supplier to try and take more cost than we've already got in our plan out of the supply chain. So deferral and removal of investment in OPEX, more cost out of our supply chain, and I'm not adverse to taking cost out, Roger. I don't think we have to make that decision just yet.
Right. So you'd previously forecast that your loss would be less than 2 million, and I think your forecast now is that it'll be better than last year, which I think when I looked at the numbers looked to be minus 2.9 million EBITDA. Is that what you're signaling to us?
Yes, it is.
Right. Okay. So where will that place you in terms of cash by the end of the year?
We don't see any issue at all, Roger. As of today, we have 3 million in the bank, and there's the proceeds of the underwrite still to come through following the AGM meeting. So the expectations are that we'll close the year, depending on where working capital ends up with sales volumes, at somewhere between 3 and 4 million. So we don't have a cash issue now, and there are some things we're working on in terms of the marketplace with obtaining trade finance through customers that will help to facilitate the position even further.
Yeah, and Roger, I think the way we're looking at this from a cash point of view is, as Howard said, certainly with the outcome of this capital program we're going through now, we're in good shape this year, and actually I think we've got control over what next year could be. I mean, we've got some decisions to make around how much we grow next year. I think some of that is within our control in terms of what markets we want to open up or not open up. I mean, I think we've got the ability to manage within our means now. We've got a flexible supply chain. that is pretty close to being fully implemented in East West. So we've got more cost opportunity there, or cost flexibility there over the long term. Our new products, the new motor, the new controller, are almost done, to be frank. I mean, there's still qualification and testing and trials. There's some capital investment that remains in those products to set the supply chain up to manufacture them. But the majority of the design investment, should I say, is completed in those products, or will be certainly over the next kind of 3 months. So we're kind of moving into the next phase of that new product, which is tooling up the supply chain and setting up the manufacturing process. And then we just control spend and how fast we grow to make sure we're managing within our means.
Right. Well, I mean, probably in the questions for me, but the one point I'd make is I think this downgrade is that you've just made, although I understand the reasons for it, and crap happens in business, but I think it's cut your access off to equity markets for a very long time, and personally I think you'll need some access to new capital before the equity market is willing to give it to you. So I think you now face a quite unusual problem, even if your business is improving, and I just hope the company is aware of that and acting accordingly.
I would say we are, Roger, absolutely. So I appreciate the feedback. Thanks.
That's all from me.
Thanks, Roger.
It appears there are no further questions at this time. I'll now hand back to Mr. Allen for any additional or closing remarks. My apologies, we have one late question from the line of Kevin Bennett from Harbour Asset Management. Please go ahead.
Greg, could you just give a bit more colour on sort of pilot customers for the controller?
Yeah, I will, Kevin. Unfortunately, I can't give you the names of those customers, just because there's various confidentiality agreements that we've got with specific trial customers. But I'll give you a bit of colour on the process we're going through over the next 6 months to get those field trials done. So the types of customers we are moving towards field trials are both brands. So I would say, the end customer for the refrigerated product, and also the manufacturer for those brands. In between those brands and the manufacturer is often in the beverage world certainly, a bottler. The guys who actually, put the soda in the bottle, but also in many cases manage the fleet of coolers in the market. We're also in pretty solid dialogue with some of those bottlers because they, in many cases, are fleet managers. So those are the types of, all three of those customers we are moving down a path of doing trials with. Now, the brands ultimately are not the buyer of technology in this space, but they influence the technology. The bottlers and the manufacturers of the cabinets are the buyers for not just controllers, but motors and any other technology, LED lights. The important thing I'd just reiterate then is those bottlers actually are fleet managers. So when they put new solutions in their markets, they treat those field trials as something that would improve access to or management of their fleet. So that's actually, part of the rollout strategy that we're really focused on now, is how do we have the right conversations and do the right field trial deals. You actually have to do a deal for a field trial before you actually do a deal for a volume solution. It's a hurdle we have to get through. So it's we've got a fairly robust funnel. We've got active conversations going on with all of those constituents. We've also got trial products, hopefully in the next 3 to 6 months, going into some shows, some not shows that we're doing, shows that our customers are doing. So it's exciting, actually, that we are getting early signals that bottlers and manufacturers are ready to put our controller in their coolers and take them out in the field to put them through the ringer, so to speak.
Greg, just a follow-up. I mean, in chasing the sort of the new core customer or whatever, we're not going to have any issues about pricing it to sort of attract the first customer like we did with Coke. We end up with having basically your core customer priced as an entry-level proposition that sort of affects margins for the next going into perpetuity?
That's not the way. Look, we're not going to have any issues. I think I'm just thinking about how I'm going to answer you because there's a couple of answers I could give you. So the way we're approaching pricing for this, there's two layers of pricing. Without giving too much away from a competitive point of view, because this is a public call. There's the pricing for the hardware, Kevin, which is really quite robust in terms of we know what the costs are, we know what margins that hardware would typically make in the market, and we want to be competitive on the hardware margin. Then there's the pricing for the value-added features, which is the software offering that we've got, which is developed and actually working today. We're actually showing that to some selected customers. That's a different level of pricing, and there's a lot of flexibility in that. But because it's value-added pricing versus hardware pricing, it's a lot easier to price in that value. So I think we might come under price pressure on the hardware, and we might look to, because we're entering a new market and we're crossing that chasm, we might look to be a bit more aggressive on the hardware pricing to get in the door. But we've got some value-added features that our competitors don't have, and that's where we would make sure that our margin attainment was solid and was attractive, because we've got a lot of flexibility on those features and how we price them in or price them out. So that's how I'd explain it, but I'm not going to be buying the business, Kevin. I think this product is it's getting too much positive feedback from some pretty important end customers to think we'll have to do that, to be fair.
Thank you.
Once again, as we have no further questions on the line at this time, I'll now hand back to Mr. Allen for any additional or closing remarks.
Thanks, operator. And thanks, team. Look, I guess I'd just close by saying we took this situation in terms of the downgrade quite seriously over the last couple of days, as you'll see, and it is concerning, but we honestly think that the actions we're working on are the right actions, and we've got everything in place going forward to both solve some of the systemic strategic issues like market concentration and customer concentration, which I've talked about before. That will be solved by a broader product range, by entering new markets, by adding customers, and I can't imagine that this Latin America and particularly Mexico situation is going to last forever. So making sure we maintain those customer relationships in the right competitive position from a cost point of view and have the right products coming to market means when that market does return to where we'd like it to be, we'll be there. So that's our strategy. We're kind of staying the course and getting on with it. And of course, going forward, we want to continue to update you all on how we're doing and also what the markets are doing. And not that this wasn't an issue, but it's not something we're not addressing through our strategy. So thank you for your continued support, and we'll hopefully see you at the AGM on Monday. Thanks, operator. Thanks, everyone.
That does conclude our conference for today. Thank you all for participating. You may now disconnect.
Thank you very much. And good afternoon, everyone, and welcome to